interrupted.
No, it's not. So, I suppose I'm supposed to talk about socialization of risk, and I will in a way, but I don't really like the name, because if you talk about socialization of risk, it sounds as though you're running up the red flag that used to be over the Soviet Union. And, you know, that's really not, I think, what Nonnie was talking about, and it's certainly not what I'm going to talk about. The idea that government and society take over some of risk in order to have a society is fundamental. If you think about it, everything that government does has some aspect of that. Why is government in the business of national defense? Well, that has something to do with risk and minimizing risk. Why is government running a police force or a fire department? That has something to do with risk. And so the idea that you would call it socialization of risk, I think, gives you the wrong impression. The real question is, how should a society manage the fact that there is a lot of risk and that society has a role as well as individuals? And society plays that role sometimes by providing the insurance, sometimes by telling people what you can do and not do as you provide the insurance, and sometimes by doing things that aren't called insurance but are effectively also managing risk. So the first fundamental question is there a role for government in insurance? And the answer is, of course. And I guess my children would say, duh. I don't think anyone really challenges that. You would be, if you didn't have a role for government, you would be returning to the dark ages, where you have the poor or the sick dying in the streets, and nobody does anything about it. The very existence of emergency rooms in hospitals is an example. I mean, we're all going to do something about the fact that people get sick, and some of them can't afford to pay for it. So Nonnie's absolutely right when she suggests that the answers to how much are nuanced things. No one is going to argue to go in a free market democratic society to either pole, to take the government out of risk handling or to say that the government should do it all. It is a nuanced thing. It's going to be in the middle. And so the question is, how do you evaluate how much and what's sensible and what isn't? So why is there a role for government? I don't think I need to say much more about it, but I can be a little more specific. One of the reasons is that you have things that can happen, like an insolvency of a large institution, that take innocent victims down. And so you try to do something about that. An example of that would be the FDIC insurance. You have risks that are too large, as Nonnie referred to, like earthquakes and floods. You have things that society has an interest in. That's the emergency room or health insurance. If we don't do that, then you have an epidemic. So you gotta do it. Even if you weren't compassionate, you have to do it. And then you have a reason that doesn't usually come up, but that I'm very interested in, which is that sometimes you don't like the way the free market is going to price the risk. It just isn't the right answer that the free market is going to come up with. And a sort of example of that most people would agree on is if we don't charge people for Medicare according to their genetics. Well, we could, and that would be more accurate, be a lot less fair, and I think most people agree with that. And auto insurance is another one of those things where people have adjusted the free market prices because they don't really like the free market answer and shouldn't, for reasons I'll go into in a minute. Now, so what are the arguments on the other side? Those are reasons why government has to be involved. What are the reasons why you want to be careful not to have government too involved? And the answer is that sometimes, but not always, government can be inefficient or not very good at doing this stuff. And, the Social Security Administration runs its insurance program with something like 1% administrative costs, so it is pretty good at that. But there are other things that you can imagine it would do that it wouldn't be all that good at. Second, as Nonnie pointed out, it can create moral hazard, because if you don't make people responsible for things you can control that you want them to do, they may not do them. Third, government can take on, it can want to do things out of good motive and take on huge liabilities that it has no simple way to pay for. And so government's struggling with that now. And fourth, if you have government deeply involved in a lot of these mechanisms, it is very tempting for private parties who are also involved in it to try to capture the part of government that's doing it and turn it to their financial advantage. So again, that's why you need a balance. You don't want to not have this, and you don't want to go hog wild overboard and do it carelessly. So let me give you two examples that are very much on my mind. One is auto insurance. That's the field I'm in and that I regulated when I worked for Governor Dukakis, where I think government is reasonably successful. There are still issues in auto insurance, but government is reasonably successful at striking the right balance. You don't really want to have perfect free market insurance, because at least those of us who know the business know that the best predictors of whether you're going to have automobile accidents or car thefts are things you don't want society to use as variables. That is, the poorer you are, the more likely you are to live in a congested neighborhood, the more likely you are to live near a car thief, and so you're going to pay the most for auto insurance if you're really poor. And so as Nonnie says, whether you want to have a free market system or a more regulated system, you got to have some limits on it for it to be fair at all. And so we do. We have more limits on it here in Massachusetts than they do in other states. It's fairer here than might be sometimes. Nonnie, with whom I agree on 99% of things. Sometimes we fight because I probably would want a little more of that kind of regulation than she might want. But we're basically in the same camp. But nobody is really in the other camp, that is the extreme other camp. You don't find even the most extreme free market types saying you ought to be able to price auto insurance on ethnicity or race or you know, the sort of forbidden variables. And you don't want it to just be based on whether you're rich or poor, which some companies would probably be tempted to do. So you have an in-between solution, and it works pretty well. So that, to me, is, as I say, it's an in-between example, and it goes back and forth. So Massachusetts has moved in the direction of more competition, more free market recently, but nowhere near all the way. And you could move a little the other way. It gets tinkered with. It's a pretty decent system and a pretty good in-between solution. So now let me give you the bad example, the unsuccessful example. And that is in banking regulation, where they have really screwed this up. I think that's the technical term. When I was born, the only people who were insured through the banking system were people who had some level of FDIC insurance on deposits. And that was okay. Then we began to get not exactly more insurance, because there's still actually very little concrete insurance in the system, but we got this implicit insurance, and that's where we got trouble, because Fannie Mae and then Freddie Mac got implicit guarantees, and the banks got so large that they got implicit guarantees, and the result of that is what you saw in Nonnie's chart and what has happened all over the world today. That is a result of doing this kind of government tinkering with handling risk in the wrong way. And I just want to give you some numbers, just to give you an idea of how wrong I think it has been. Take Fannie Mae and Freddie Mac first with their implicit guarantees. In 1970, the idea was supposed to be that securitization and the implicit guarantee would provide a higher percentage of home ownership in the United States, as a higher percentage of the population would own homes. So what are the numbers? In 1970, when the very first securitization under this implicit kind of guarantee occurred, the percentage of home ownership in the United States, remember this number, was, if I had a slide and just had this number on it, 65.7%. Everybody got that? Okay, so what you got was an extreme version of the private industry trying to capture the parts of government that regulated it. Securitization took off, regulation disappeared, and the result of that is that home ownership today, what is the percentage of home ownership today? 65%. It is a little lower than it was in 1970, before you had securitization, before you had these giant implicit guarantees, and before you even had giant banks. That's another place we screwed up. By having the implicit guarantee for large banks had an advantage over small banks. And large banks got bigger, and then we dropped all the regulation and made large banks not allowed to get bigger. All of that regulation disappeared. And so, quick statistics on that. I think that the market share of the 10 largest banks in 1990, not very long ago, was still 15%. It is 50% today. Well, they messed it up, and they messed it up really bad. So that is an example, I believe, of really terrible failure of mission here. None of the goals that were supposed to be accomplished in the way insurance to banks was handled have been accomplished, none of the good ones, and we have this terrible result that economists tell me that the harm is measured in the trillions of dollars now. I'm not even sure that you can sort out, when you look at the European crisis that's going on at this very time, that you can sort out how much of that crisis would be on people's minds if you didn't have the president of France worried that his 3 largest banks are going to fail. And that's influencing this crisis. It has to. This is in part the same crisis we had in the United States. It's in part a country crisis too. So I don't mean to say that it's just that, but again, it's the same screw up. So I think that we could design a system for this kind of government involvement in what needs to be protected in the banking sector, but we haven't. And the consequence is that we have these out of control banks, out of control size, out of control leverage, and taking 40% of all the profit of the American corporate sector, which is enormously more than they took before we fixed it with the degree of government guarantee there. So, let me just say in conclusion, government needs to be involved in the management of risk. It always will be, it always has been. It will always have this, in a free market democracy, this in-between role where it isn't trying to do it all, as it actually did in the Soviet Union. That didn't work very well either. And it isn't going to have none. Those are not possible. It is going to be in between. You have to be extremely careful in between, because you really can screw it up. And when you do screw it up, you get something like what we had. So at that point, I will stop as well.